Most videos about required minimum distributions will tell you to worry about them. This one will tell you the opposite, with one specific exception that changes everything. If you handle your retirement accounts correctly in the decade before you turn 73, RMDs become a non-event, a minor annual task, something your accountant manages in 20 minutes. If you make one particular mistake, a mistake most people make without realizing it is a mistake at all, RMDs become a tax problem that compounds for the rest of your life and costs you, conservatively, $3,000 to $8,000 per year in unnecessary taxes until you die. The mistake is not complicated. It is not obscure. It is something millions of disciplined, responsible savers do every single year, because nobody tells them it is a problem until it is too late to fix. Let me show you exactly what it is. First, the basics. Fast. When you contributed to a traditional 401k or IRA, you received a tax deduction. The government deferred your taxes, but never forgave them. Starting at age 73, the IRS requires you to withdraw a minimum amount from those accounts every year, whether you need the money or not. You pay ordinary income tax on every dollar. Miss the withdrawal and the penalty is 25% of the amount you should have taken. The formula is simple. Your account balance at December 31st of the prior year, divided by a life expectancy factor from an IRS table. At 73, that factor is 26.5. At 80, it is 20.2. The older you get, the larger the percentage you must withdraw. For most retirees with modest balances under $500,000 in traditional accounts, RMDs are manageable. The annual withdrawal is not much larger than what they would have spent anyway. No real problem. The problem appears for the disciplined saver, the person who maxed their 401k for decades, the person with $800,000, $1.2 million, $1.8 million in traditional accounts. And it appears because of the one mistake. The mistake, keeping too much in traditional accounts into your 70s. Here is what happens. A retiree with $400,000 in a traditional IRA at age 73 has a first RMD of approximately $52,800. Add Social Security of $32,000, of which 85% is taxable. Total taxable income, approximately $80,000. Federal tax bracket, 22%. Medicare IRMAA surcharge triggered. Total tax bill, roughly $14,000 to $16,000 per year, on money they did not choose to spend, on a withdrawal schedule they cannot control. Compare that to a retiree who spent the decade between 60 and 73 doing Roth conversions. Same starting balance, same Social Security, but they converted $40,000 to $50,000 per year from traditional to Roth, paying 12% to 22% tax on each conversion during years when their income was low. By 73, their traditional balance is $600,000 instead of $400,000. Their first RMD, $2,600. Their total taxable income, under $52,000. Their federal tax bill, under $5,000. Their IRMAA, zero. Same person, same career, same savings discipline. The difference in annual taxes from 73 onward, $9,000 to $11,000 per year. Over a 20-year retirement, $180,000 to $220,000 in avoidable taxes. That is the one mistake, not a dramatic one, not a reckless one. Just the quiet accumulation of more traditional account money than the tax code will let you withdraw efficiently. Subscribe. The fix is simpler than the problem, and I'll show you exactly how to run your own numbers. Not a financial advisor. Everything here is research and analysis. RMD rules change and interact differently with every individual situation. Please consult a qualified financial advisor or CPA before making any decisions. Now let's continue. The fix is called the Roth conversion window, and if you are between 59.5 and 73, it is available to you right now. Every year between retirement and your first RMD, you can convert a portion of your traditional IRA to a Roth IRA. You pay income tax on the converted amount at your current rate. The converted money then grows tax-free and is never subject to RMDs. The strategy: convert enough each year to fill your current tax bracket without crossing into the next one. In early retirement, before Social Security begins, many people are in the 12% bracket, the lowest they will be for the rest of their lives. Converting $30,000 to $40,000 per year at 12% is one of the best tax trades available anywhere in the financial system. The math: converting $40,000 per year for 10 years at 12% costs $48,000 in total taxes. Leaving that $400,000 in a traditional account, watching it grow to $700,000, and being forced to withdraw it at 22% over the following decade costs approximately $154,000 in taxes. The conversion saves $106,000 from one decision made annually in the decade before RMDs begin. This is not a loophole. It is not aggressive tax planning. It is using the tax code exactly as Congress designed it, paying taxes when rates are low, so you do not pay them when rates are forced high. Here is the number to run this week. Take your current traditional IRA and 401k balance, projected at 6% annual growth to age 73. Divide by 26.5. That is your estimated first RMD. Add your projected Social Security. If the total is above $44,725, the top of the 12% bracket for a single filer, you have a tax problem already being built inside your accounts. If you are married, the 12% bracket extends to $89,775. Run the same calculation for both of you combined. If your projected RMD plus Social Security exceeds your bracket threshold, every year between now and 73 that you do not convert is a year of compound tax damage. The window is open. It closes at 73. RMDs are not the enemy. The tax code is not broken. The problem is specifically the gap between what most people know about traditional accounts, put in as much as possible, defer as much as possible, and what the tax math actually requires at 73. The people who handle RMDs well are not smarter. They ran one projection 10 years early and made one annual decision. The people who pay $9,000 extra per year in retirement never ran the projection at all. Run the number. If it is fine, you now know why, and that is worth something. If it is not fine, you have time to fix it. Both outcomes are better than finding out at 73. Tell me in the comments, have you projected your RMD yet? And if you are already past 73, did anyone walk you through Roth conversions before your first distribution? I read every single one. Subscribe. Next week, we are covering investing versus paying off your mortgage, the real math, with a clear winner depending on one number you can calculate in 5 minutes.